Nouriel Roubini is a world-known economist. He helped foresee the credit crisis of 2007-2008. He is the host of NourielToday.com. Thank you for being with us. Appreciate your time.
Great being with you today. Thank you.
So I want to start, Nouriel, with your current thoughts on just how bad this can go. I know you've written and talked at length lately about the components that could take this from recession to depression. As you consider those, how are we doing? How are governments doing? How is the reopening going? Are you worried that we're veering towards a bigger slump?
Well, there are three scenarios for how things are going to develop in the global economy, North America, this year. My baseline is one of a U-shaped recovery, where the recovery is going to be anemic, subpar, below trend, very anemic. The optimists and the markets, at least the equity markets in the US, are pricing in a V-shaped recovery with very strong growth in the second half of the year into next year. And of course, there is a risk of a L, of what I call a Greater Depression. That's my baseline for the rest of the decade, but not for this year. I think that there are forces that are going to lead us to a depression by the middle of the decade, but it's not the prediction for this year. Essentially, my view is that there's going to be a U because this is a global shock. Both households and corporates will have to spend less and save more. Precautionary savings are going to go higher. Income is going to be lower. And then there will be less capital spending, both by the corporate sector and the household sector. They have to deleverage. For household, capital spending is purchase of new homes. So you spend less, you save more, you do less capex. There'll be a global investment slump. There'll be a global savings glut. That's a recipe for very anemic recovery of the US, of Canada, of the global economy.
So the one thing that I think sets you apart from many others, and that would include the vast majority of investors, is this notion that this is a crisis, that we all recognize that there will be a contraction. The question is how long and how deep related to this crisis. You believe that later in the decade is when there's a price to be paid, that this potential for depression and deep slump happens much later. Is there anything between now and then that we governments could do to stave that off?
Unfortunately, I fear that there are some major trends, and in a recent publication, I discussed what I call the 10 deadly Ds. They're going to lead us to a greater depression sometime later in this decade. It's only a matter of when, not whether. And I think that even if we're going to do monetary and fiscal stimulus or reform, I think the train has left the station, and the train wreck is a slow motion one. It's not going to happen this year, but we have fundamental forces like debt and deficits, both private and public, are going to lead to insolvency. Unfunded liability coming from demographics is going to become worse, and with all healthcare spending. We're going to have initially deflation, and real value of debts are going to increase, and that's going to make more people more insolvent. Then we're debasing currencies by doing effectively quantitative easing of large fiscal deficits. That's eventually, with negative supply shock, is going to lead to inflation by the middle of the decade. We have also the digital disruptions. If we're going to reshore economic activity from China and Asia to North America, we'll have to substitute labor with capital, and firms are going to have to cut costs to save more and spend less. And that's going to imply more automation, more robotics. We are in the process of deglobalization, of decoupling between US and China. We are seeing this democracy backlash. People are becoming scared, are becoming more populist, and you have authoritarian populist government coming to power all over the world. And we have also this duopolistic strategic rivalry between US and China. The Cold War between US and China is becoming colder. It's going to get very ugly. We have digital rivalries. Cyber warfare is going to get worse over the next few years. This is the way warfare is going to be. It's not going to be conventional wars. The enemies of the West and the US, whether it's China, Russia, Iran, North Korea, they cannot fight the US and the West with conventional weapons. They're going to use asymmetric warfare, cyber warfare, in a way of weakening our economy, society, politics, and interfere with the US election. And then finally, we have also these, what I call deadly man-made disasters. Pandemics and global climate change are not natural disasters. Even pandemics come from poor health condition, destruction of ecosystem, and so on, let alone global climate change. So you have 10 forces that are very fundamental, that existed even before this crisis, and each one of them, if you think about it, is exacerbated and accelerated and made worse by this crisis. and therefore we're going to end up into a Greater Depression. It's going to happen this decade, and policies cannot do much about it, because actually the policies of more stimulus, monetary and fiscal, credit and otherwise, are going to actually exacerbate the debt imbalances. They're going to exacerbate the debasement of currencies.
Yes.
And with negative supply shock coming from deglobalization, protectionism, and populism and economic nationalism, that's going to increase the risk of stagflation, recession, and inflation down the line. Today, the risk is deflation. In a couple of years, we'll have risk of inflation, like we had when we had negative supply oil shocks in the 1970s. So we're seeing ahead a Greater Depression, I fear.
So then, I mean, as you note, many of those things would have been a risk, were already a risk. They are being exacerbated. I just want to focus on one of the Ds. It's one of the first, and that's the debt level. Personal and, of course, sovereign. We are in way over our heads. We were before this great crisis. In terms of how we get out of it, is there a natural path that would resolve that? Because it doesn't seem clear with governments behaving the way that they are.
Well, in the last decade, debt levels went higher. Initially, the global financial crisis was too much private debt, and then we socialized the losses. There was a massive increase in public debts. Estimates are that public and private debt as a share of GDP is now 350 as of the end of last year, but this year it might be closer to 400. In advanced economies, it's 388, less than 300 in emerging markets, and in China is also above 300%. So the debt ratio are going to become higher. In the last decade, what saved us was that while debt ratio were high, and there was a rhetoric about deleveraging, but there was not much deleveraging occurring, debt servicing ratios were low, because we had short rates close to zero, if not negative, like in Europe and Japan, and we had long rates low. Now, again, the same thing is happening right now. The policies of zero policy rates or negative or QE are leading to short and long rates to be low, but they are low only for safe sovereigns and safe people in the private sector. You can have zero policy rates, you can have bond yields close to zero or negative, but credit spreads in the private sector of those that are highly indebted, whether they are households, corporate, large and small ones, financial institutions, banks, non-bank shadow financial institutions, and the country overall, those credit spreads can explode if you have a situation of excessive leverage. And we had an explosion of leverage in the private sector, especially corporates and shadow banks in the US and parts of North America. And therefore, it doesn't matter whether bond yields are close to zero for safe governments or policy rates are zero, credit spreads can blow up. And if they blow up, you'll have a debt crisis. So now you have a deadly combination of rising debt levels, they're going to explode, and you'll have now credit spreads much higher than before. Yes, some central banks are now buying corporate bonds and not just investment grade. The Fed decided even to go into the risky junk bonds, but it's only fallen angels. Those that were investment grade are now just below. There are tons of other firms that are deep into the junk bonds, and they're not going to be helped by the Fed. They cannot be helped by the Fed. Just this morning, announcement that Hertz, major auto rental company, is filing for Chapter 11 bankruptcy. You'll have major institutions, large and small, they're going to go bankrupt. So we have a debt crisis going to become explosive, and with demographics and more spending on healthcare is needed to deal with pandemics, we'll have unfunded liabilities from healthcare systems that are unfunded, like US Medicare and most of the world that are pay-as-you-go. And then you'll have debt deflation because prices are going to fall in the short run, wages are going to fall, and the ability of people to service that debt is going to be reduced. That's what's called the debt deflation kind of a dilemma or scenario. So all these things are going to lead us to debt crisis over time.